You're listening to AI PRISM from Seoul Economic Daily.
It's Thursday, June 25th. Here's why global investors are paying attention to Korea today. We're diving into, well, this historic leverage shock in Korea for you. Because we really need to figure out if this massive $2.5 billion single-session foreign outflow from the KOSPI is just like a forced liquidation flush, or if it's the start of a structural re-rating.
Yeah, that's the big question right now.
I mean, I look at $2.5 billion evaporating, and it doesn't look like panic over tech fundamentals to me. It looks like an algorithmic avalanche,
Yeah.
like a machine malfunction driven by just cold, hard math.
Oh, it was entirely mechanical. I mean, to really see the gears turning, we have to look back to May. So Korea launched these single stock, 2x leveraged ETFs on giants like Samsung Electronics and SK Hynix.
Right, the big heavyweights.
Exactly. And retail investors just flooded in because, well, the KOSPI had surged almost 80% in the second quarter. So total leveraged investments ballooned to roughly 74.8 trillion won.
Which is what, about 53 billion US dollars?
Yeah, 53 billion. So that is precariously loading the system with risk, right?
All right, so we have $53 billion sitting in funds designed to, like, double the daily movement of these stocks. And then we get this slight shift in AI sentiment. I mean, it was just a few Google engineers moving to rival firms, right?
Yeah, just a tiny sentiment hiccup, really.
So why does that tiny hiccup trigger a nearly 10% crash in the broader KOSPI index?
Well, it triggers what's called a short gamma loop in those leveraged ETFs. Because they promise double the daily return of the stock, they have to reset their exposure at the end of every single day.
Wait, hold on. Break that down for me. If the underlying stock drops, why do they have to sell? Wouldn't a standard fund just, hold the shares and wait for a rebound?
Well, a standard fund would, but a leveraged fund uses borrowed money. So if the underlying stock drops 5%, their total asset pool shrinks.
Oh, I see where this is going.
Right. So to maintain that strict 2-to-1 leverage ratio for the next morning, they are mathematically forced to sell off shares.
Wow. So they're selling into weakness, which drives the price down even further, forcing them to sell again the next day. I mean, it's like a thermostat wired backward, right?
That is a great way to put it, yeah.
Like turning on the AC when the house is already freezing.
Huh.
The ETF structure itself manufactures the crash.
Exactly. And that backward thermostat effect didn't just stay local. I mean, the contagion rapidly crossed borders. Over in Hong Kong, an SK Hynix ETF swelled to almost $16.8 billion in assets.
$16.8 billion, wow.
Right. So when that fund started mechanically liquidating, global institutions had to balance out their immense Korean exposure losses. And they did that by mechanically selling off U.S. chips.
Which explains why the Philadelphia Semiconductor Index dropped 7.87%, dragging Micron down over 13%. I mean, a retail tech dip in Seoul effectively forced a sell-off on Wall Street.
It really did.
But what confuses me is Korea's internal market structure. Like, doesn't the National Pension Service usually step in as a shock absorber during crashes like this?
Normally, yes. The MPS is the market's anchor. But we have to look at the prior quarter. Because the KOSPI had just surged 80%, the pension fund's domestic equity allocations reached their strict, legally mandated target bands.
Wait, so because the market had gone up too much previously, the ultimate market stabilizer was legally forced to become the market's biggest mechanical supplier.
Yeah.
Right when it needed support.
They had absolutely no choice. The National Pension Service net sold 2.3 trillion won, so about $1.6 billion, in June alone just to rebalance their portfolio.
Wow, that timing is just brutal.
Right. So you have ETF mechanical selling colliding directly with institutional mechanical selling. And to make liquidity even tighter, China simultaneously hit offshore brokers with $330 million in fines.
Oh, geez, more pressure.
Yeah, totally squeezing the capital channels flowing through Hong Kong.
So if looking at my portfolio's Korea waiting right now, this sounds like a pure liquidity event. The companies themselves aren't broken. I mean, the market's plumbing just backed up.
Exactly. The data points strongly to forced liquidation rather than fundamental weakness. The immediate signal to watch for is the June 30th NPS deadline.
Just to see if that institutional selling finally clears up.
Right. But the true structural shift to watch is happening on July 10th. SK Hynix is executing a Nasdaq ADR listing, and they're aiming to raise roughly $32 billion.
Okay, let's clarify that ADR really quick, an American depository receipt. They're essentially creating a U.S.-traded certificate for their foreign shares, which allows U.S. investors to buy in without navigating the local Korean exchange. Will that finally give Korean tech a fundamental anchor that's immune to local retail leverage?
Well, that's the goal. By listing in the U.S., SK Hynix can attract passive global fund flows, and these funds operate entirely independently of Korea's domestic retail dynamics.
Though bypasses the local drama.
Exactly. If successful, it fundamentally bypasses the local volatility we just witnessed.
Which brings up a slightly terrifying, broader question to leave you with. If local retail leverage in Korea can violently drag down global U.S. semiconductor indices in a matter of hours, I mean, what hidden short gamma traps exist in the broader $290 billion global leveraged ETF market?
It's a great question and definitely something to watch.
Definitely something to keep in mind the next time you check your portfolio. Thanks for joining this deep dive, and keep an eye on that hashtag KOSPI.
You've been listening to AI PRISM from Seoul Economic Daily.